financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rayam.
Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it. Thanks again. For more information, you can visit us at hugyourmoney.com. So I'm here with Ben Braverman from SMS Financial Services. Thanks for joining me, Ben.
My pleasure, Francis.
Thanks. And I wanted to do this just to get the word out about what's going on right now, because I think this is a limited opportunity and rates will change. And we don't want to feel bad that people didn't take advantage of something really great when it existed. So you're fond of a phrase that I've adopted and love, saying income is on sale right now. So can you tell us a little bit about what you're alluding to there?
What we all can agree on is interest rates right now are much higher than they were 3 to 4 years ago. What that does in the indexed annuity space relative to guaranteed income, so when I say guaranteed income, I'm talking about the ability for you to give a financial professional like Francis X amount of money and in a certain number of years have an unequivocal guarantee of an income stream, essentially a private pension in retirement, that'll never run out. So interest rates are high. Insurance companies have the most yield they've ever had before. That yield can be given back in the form of higher guarantees to clients. And for that reason, we're saying income is on sale. Because in 2020, the 10-year Treasury, which is a nice benchmark in our industry for interest rates, was at 60 basis points, which is an obnoxious financial way of saying 0.6%. Right now, the 10-year Treasury is at 4.1, 4.2%. So when I tell Francis or when Francis gets the word out that income is on sale, what she and I are trying to communicate is that if you're someone who's at, in, or near retirement, and you have the opportunity to lock in these high guaranteed income rates, that's retirement financing, not totally unlike individuals that we all know, and some of us might even resent, who locked in 2.5% to 3% mortgages, right, 3 to 4 years ago. They locked that in. That was a super attractive thing that they could only get. And who knows, I'm not a mortgage expert, but it might be hard to ever get a rate like that or get a rate like that for quite some time. So this is the same type of buying opportunity for individuals at near retirement. That income is at a significant discount because rates are so high, and the guarantees, the unequivocal guarantees you see today may not be here to quite the same degree a year from now, 2 years from now, certainly 3 years from now, as rates will eventually come back to earth.
So Ben, will you tell people, because it sounds like maybe you're recommending this product, but you are not, in fact, in sales. Can you explain what you do for people who are listening?
Yep. So I'm a consultant to financial advisors on marketing and product. So I help financial advisors grow their practice, get more clients, and then help them navigate the waters, because there's hundreds of indexed annuities out there, hundreds of different indexes. So I help advisors select the best product for their clients, but in no way, shape, or form do I directly solicit business from consumers. I'm what's known in the field as fundamentally a wholesaler or a marketer. So I act as an intermediary, and I've done this as an intermediary in the mutual fund space, which also has wholesalers, variable annuities, and now index annuities. And I get to work with people like Francis.
Nobody can call you and buy this annuity directly from you. They have to buy it from someone who's licensed in the field to do that. And those of us who rely on you. When I call you and I say I have a certain case, or I use the term privatize pensions as well, because people have those options they can take from their pension. And one of them is to roll it outside of the pension. And if we can do better doing that for somebody and give them more options, more freedom, more liquidity, delay the taxes for a while if we want to. There's so many reasons to do this, but I want the best product. And so we've talked a lot lately, and I've just worked with a number of people who were forced to make their pension decision because the company made a change. So they all got letters saying, you have to make your decision by this date. The options they were given were, you can take a single payout, You can put your spouse on it, in which case you are reducing the amount that you'll get monthly, expecting to give money to your spouse. But the big hiccup here is if your spouse predeceases you, you've sacrificed that money for the rest of your life. You can't just go change your beneficiary like you could on this kind of an annuity. You could just put whoever you want on it whenever you want and change your mind accordingly. So they can take a single payout, a spousal payout, or they can transfer to an account that has been set up for them, but usually which, they don't know a lot about. In this case, they didn't even know which company it was going to be. And take your chances, or you can transfer the money out of there as a non-taxable transaction and roll it into something like this annuity. This particular annuity gave them a 30% upfront bonus for income purposes, 30%, and an 8% minimum roll-up guarantee for 10 years or until they turn income on, whichever is sooner. And they still have more liquidity and the ability to change beneficiaries. But what that does is it takes somebody who might have had some losses in the market or who might be saying, gee, I'm getting close to retirement. I'm not ready to turn on my pension income yet, but I sure would like to make the most of it. And it drops another 30% on top of that, and then an 8% minimum guarantee, which is why we're saying income is on sale. If you could go to the bank and lock in an 8% CD for the next 10 years, my guess is you would run at it, you know? And if they
Yeah.
offered you a 30% bonus on top of that, plus more market upside potential, I mean, that's the worst it can do. So people often say to me, well, that sounds too good to be true. There's no free ride. Where is this company making money? So again, I'm going to ask you to explain where companies like this make money. And we are talking about a big, fat, healthy insurance company, A+ rated carrier with a huge history.
So first of all, thank you for making it clear. I am not a distribution for consumers, so that I am not the person to call if anyone is
Ben.
listening and thinks a private pension and retirement sounds interesting. I strictly deal on the institutional level. The other thing about pensions, and the reason why we see a lot of pension replacement, is even if you can get a couple dollars more from an annuity, or maybe even a couple dollars less, you actually still have control of the asset. Once you
Right.
annuitize a pension, that asset is fundamentally gone. There might be some type of spousal death benefit or some type of spousal continuation, but with an indexed annuity, should your circumstances drastically change, be that an inheritance or anything else for that matter, you could turn off the income and still actually have that asset, versus making a decision to take that pension and then never having any freedom or flexibility with it. In addition, there's a lot of concern, rightfully so, about some pension solvency. You see pension funds being sometimes mismanaged, and that's not my area of expertise. I'm not going to talk about specifics, but you can do a quick news search and gather pretty quickly that not all of these pensions do you feel 100% about, versus, as Francis alluded to, an A+ rated insurance company. The other thing I would add, we talked about this on the show a few weeks ago, but when Francis says 30% bonus, 8% compounded roll-up, what does that fundamentally mean? That means that you as the consumer can put in, and these are numbers I'm kind of pulling out of a hat, but put in $100,000 and be guaranteed $10,000. What is that? That's 10% of your initial purchase payment guaranteed for the rest of your life. Think about it like purchase payment, and it becomes much easier to understand. The one other thing I want to touch on before we get into pricing is something called annuity alpha. So when you're in growth mode, when you're growing your retirement assets, when you're contributing to your 401k, or your financial advisor is managing your post-tax or pre-tax dollars, what do you want he or she to do, or for that company to do? You want to grow, and that's known as seeking alpha, okay? But once you get into retirement, what's the most important thing to you? Is it to grow your savings as much as possible, or make sure that relative to longevity, right? Relative to longevity, be it living to 95, 99, 100, which we're saying happened. Charlie Munger in Omaha, I think, died at 99 or 100. People very much can live that long these days. You want to make sure you don't outlive your asset. Find me one mutual fund, one ETF, one combination of stocks and bonds, what have you, that can guarantee an income stream that you will never outlive, regardless of market conditions?
Right.
The
It
answer is you
doesn't
won't be
exist.
able to find it. It doesn't exist.
It can't.
So it can't exist,
Right.
which is why there will be, we're at the height right now of what's known as the silver tsunami, which is the 10,000 people turning 65 every day. We're at the peak.
Yeah.
There's still a lot more to go. And those individuals, when rates do come down, they'll still need guarantees for the reason I just alluded to, which is no portfolio for a mass affluent individual can guarantee an income stream that will never be outlived. They need a guarantee because, to bring it full circle, what part of the three-legged stool of retirement do consumers not have anymore? Savings and Social Security have always been there. What did, my parents are a bit older. What did most people's parents have that nobody has anymore? For the most part, a pension.
Pensions. Sure.
So this is that private pension in retirement.
The whole thing about pensions is when the government said, okay, we're going to augment these with a 401k, and now you can contribute to the 401k, that was meant to be in addition to your pension. But what happened is companies said, hey, we'll just give you a little match in your 401k and we'll get rid of the pension because it's expensive for us to keep. And then eventually they said, yeah, we're not really going to match much anymore or anything. And so now we're back to self-saving in a 401k. What happens for people if they maybe don't want to take the income now? I mean, let's suppose you're still working and you're in a situation where you're forced to make your pension decision. And one of your choices is, you start taking payments. You might not want those. Even after you retire, I talk to a lot of people these days who say, well, I'm not one to sit in a chair. I don't know what the next chapter is going to look like. So having this particular feature in this product that allows you to turn the income on and back off again is very appealing, because you might retire. You might say, I'm going to travel for a year. I don't really, maybe I want that income, maybe I don't. And a year from now, I'm going to figure out whether I want that income or not. Maybe you turn the income on and 3 years later, an opportunity comes your way. And now you've got plenty of money coming in from whatever you decided to do in your next chapter. You don't want to be paying tax on the income being pushed to you from your pension if you don't need it. So you could turn the income off, do whatever you want to do with the rest of your income, and later on in the future, turn it back on. It will still be at the same rate it was when you turned it off. It won't get higher just because you waited a few more years, but it's doable, and you could salvage those tax dollars by doing that. So it gives you an option you would never, ever have with your pension. Once you turn that lifetime income on with your pension, that's it. It's a permanent decision. You're not going backwards, and it's a stream of income that's going to get taxed and pushed to you whether you want it or you don't.
I'm also not a tax professional, so don't call me, please, about any of the comments I'm about to give. But in retirement, there's a lot of hidden taxes that the ability to be able to turn off income can be super important. For example, for a lot of mass affluent individuals, they don't know that their Social Security can be taxed up to 85%. That's something that you've paid for already, right?
Yeah.
But a lot of consumers don't know that that can be taxed up to 85%. And for some consumers, that's unavoidable. But if in a year they don't need as much income, or if in a year perhaps they started working a work optional job, they wanted to do something that they really enjoyed, and suddenly they have a lot of 1099 income, well, suddenly they could be taxed higher on their Social Security. The other thing that a lot of seniors in particular need to think about is IRMA.
Only
Yeah.
seniors who are married to somebody named Irma are thinking about Irma.
No. Well, this is why you want to talk to professionals like Francis, but basically your Medicare Part B premium can increase if you jump levels, and some of that can be through income. So that pension might look super attractive right now. We can probably provide something that's more attractive because income is on sale right now, but having the flexibility to harvest your income, which is a term I really like, harvest your income relative to your given tax year, is definitely preferential to just an income stream on top of Social Security that you may not need or want in a given year. So it comes back to that flexibility of retirement and working with a financial professional to adapt to said flexibility and changes.
People who know me know I don't do these shows very often where I'm very specific about a product. And although we're not giving the name of the product, we are talking about one specific kind of fixed indexed annuity. It's not the only thing we use. We use others as well. Some have cash bonuses up front rather than income bonuses like this. But for this particular need, being able to just whop a 30% bonus on top of your dollars and then add that 8% compounded roll up as a minimum guarantee, could do better, can't do worse, is really important. Now, there is a fee for this rider, which is a 1.1% fee, which is slightly less than what most mutual fund managers would charge you to manage your mutual fund. So yes, you're paying that fee, but that's what's giving you that 30% bonus and 8% roll up. Now, mark my words, the reason we're doing this show right now is because you and I talked about this, and I thought, I'm going to feel really bad if it changes, the rules change, and you can't get this anymore. I remember well when this same product had a 10% bonus and a 7% roll up, right? Now it's at 30 with an 8% roll up. If you're looking to recoup losses or maybe even move from another carrier where you're unhappy with the earnings, but you've got some surrender charges, this might be a way for you to think about putting your pension back in your pocket. You might not ever get the opportunity to do again. And anyone who knows me knows I let people make their decisions at their leisure. There's no high pressure here. I am not a henny penny. I'm not a person who says, well, you better hurry up and sign this right now. I just say, you know what? Here's what I think is best for you. If you agree, let's do it. And if you don't, then we'll keep looking for what is the right fit for you. I'm going to try to just share my screen for a moment and just show a quick little calculator. But let me just give you an idea of what this can do. I've just put in $100,000, as Ben mentioned, on a 60-year-old person, and I've run this out 10 years. So here's what happens. 10 years from now, that 100,000 would guarantee a minimum payment annually. You could take it monthly if you wanted to, but annually of almost $15,000. You can see that that 30% bonus is right here in writing, and here's the 8% compounded roll-up. Here's year one, age 60. By the next year, you can see it's gone up to 140,000 already. That's because that 30% bonus and 8% roll-up have been dumped in immediately. And you can see on this little calculator, and this calculator is open to the public. I'm happy to show it to people. You can see what happens every year you delay. Now, by the end of the 10th year, that value that they're calculating your income on has now grown from 100,000 initially in 10 years to 280,000, and is paying out almost $15,000 a year. Remember, this is a guaranteed minimum. That's the worst you can do. It's the baseline. Every situation is different. It may sound good to you. It might not be the right fit. You might not think it's the right fit. And after we talk about it, it turns out that you say, oh, well, I didn't realize I could do that. Just being able to control your beneficiaries. That one feature, forget the bonus, the 8% roll up, anything, just being able to control your money instead of just checking a box and saying, okay, I'll take whatever the designated account was that they sent me, is really what we're talking about when we're talking about privatizing a pension.
I did the math. That's about 14.9% of the initial purchase payment.
Yeah.
So that means every year I'm going to give you almost 15% of your money back to you. Not to mention, there's a cash account that's growing, right? So I like to talk about column B and column A. Column B, I might have gotten that from you, Francis. Column B is your benefit base. That's your income benefit. Column A is your accumulation value. So not only are you getting this stream of income as a complement to Social Security, but you're also getting this sustained cash value that's growing independently. And what is that? That's real money. That could be money that you could tap into should you become confined or need some additional cash. I mean, it is legacy, but there's a lot of other ways that it probably might get used first, with less than, I think, about 23 or 24% of retirees having any form of long-term care, either because the carriers have gotten unaffordable or the underwriting's too challenging. So that's real cash, and that's real value. As a complement to the guaranteed income. Yeah, that's a trip or something fun. Yeah,
that's your travel money, right?
That's your travel money versus the pension, where you're not going to have that side account. The one other thing I would add is earlier, Francis, you said sometimes consumers say, well, it's too good to be true. Well, if you're dealing with a quality carrier, it's really not, because the fact that 4 years ago, the carrier in question, 10% bonus, 7% compounded roll up. The reason that they offered that at that time was because that's what they determined they could afford and they could guarantee. Because this is what's known as a unilateral contract of adhesion. That's what an annuity insurance contract technically is. They're saying, we promise this to you, not, hey, well, not an IOU, not we'll see if we can do it. This is a hard contract where they're guaranteeing you this income. So again, it's not too good to be true. It's a reflection of the highest interest rate environment we've been in a very long time, the highest interest rate environment ever since the advent and innovation of indexed annuities, which is why it really is time to sound the bell that don't look at these products with a speculative eye. Look at these products as a big buying opportunity right now. If you could go back to 2008 and buy Amazon or Apple or Netflix at $7 or $8 a share, you would probably do it, right? That was not investment advice, by the way, if anyone's.
Nobody took it that way. Nobody can go back and do it. Yes.
Yeah. Yep. But right, if you could do that, what a time to get in. If you could get a house at a 3% mortgage or 2.5%, what a time to get in. Yes. If you can get guaranteed income where in 10 years you're going to get 14% of your money back, and that'll never run out potentially for you or for your spouse if you want to do joint or single. Wow, that to me seems like a huge buying opportunity for retirees and for those near entering retirement.
I agree. I just want to be upfront about the fact that there are surrender charges on the contract. Just like if you took out a CD and took the money out early, there would be a penalty for doing it. But they only take effect after you take out your free withdrawal. So after the account's a year old, you could take 7% of your balance out without a penalty from the company every year. Now you have to pay taxes on it, or on the growth, depending on whether it's an IRA or not, but you have access to that money. You would never have that in your pension. In addition to that, once you turn lifetime income on, you could do that after it's a year old, no penalty, right? So those surrender charges are only there to protect the company so that they know they can give you these guarantees if you should decide to just take your money out and walk away after a short period of time without turning on income or without using your free withdrawal. Simple as that. You want those in place.
If you become confined to a nursing home or you develop a terminal illness, this applies to a majority of annuities, but the one we're talking about in particular today, the contract becomes liquid in its entirety.
That's right.
I don't mean to throw shade at our friends on the money management side of things, but a lot of the objection that you'll hear from typically fee-based financial advisors who are managing money and doing a good job, but typically they get a fee, a 1 to 1.5% fee. They'll often say, well, annuities aren't liquid, and that's really bad. But can I explain real quickly why this whole liquidity thing to me? So whether it's a 9-year surrender or a 12-year surrender, first of all, you only ever typically put at most maybe 60% of your assets into an annuity. So you're always going to have liquid money. No insurance company, nor any professional advisor like Francis is going to lock up, quote unquote, even lock up all your money. In addition, as Francis alluded to, you have what I like to call liquidity corridors. Liquidity corridors is your hallways of liquidity every year that you can take out of your annuity if you need some money. But here's the other thing about this whole liquidity thing. If you have, let's say, a $500,000 IRA or qualified pre-tax asset, I already established that if you're in a nursing home or you have a terminal illness, you can access the whole thing. But under what other circumstances do you want to cash out $500,000 in taxable assets in 1 year? Right. I'm just curious, liquidity is great, have an emergency fund, but if you need to suddenly break the glass on a $500,000 or a $250,000 of your life savings, and it's not a terminal illness and it's not a nursing home, talk about a taxable event, and also other than a nursing home or something like that, when would you need that much liquidity?
Yeah.
So that would be my gentle pushback on this whole concept that these are illiquid assets. I mean, they have to be priced in that fashion. Sorry, I get a little defensive on that topic, Francis.
No, it's okay. I actually can think of one instance when somebody might want to just completely change their mind and say, I want this money and I'm going to do something else with it. So let's suppose that two people are married and the husband, now in the pension, if the husband put the wife on his pension and the wife predeceases the husband, he's stuck. He gets his lower pension payment the rest of his life. He can't change his mind on a beneficiary. He can't say, well, my life has changed drastically now and I'm going to go live in, Venezuela. I want my money. It doesn't exist. You're getting a monthly payment. That's it. But with this product, if either spouse predeceases the other, the surrender charge goes away and they have the opportunity immediately. Do I want to just take this money? So it might be the husband's contract and the wife might be the one that passes away. Under most contracts, the husband would still have to live out the terms of his contract. But under this contract, he gets to say, I'm sorry, my life has changed drastically, and I would like to take my money and do something else with it. Now, maybe he doesn't take it out in a taxable event. Maybe he rolls it to something else. But because his wife has passed away, he gets a free out. The do not go to jail, he gets the free out on those surrender charges. And that's unusual for this type of a contract. So that is a time when somebody might just say, geez, I just don't know what is next for me. And I want liquidity. I want access to those funds. And this contract gives you that for no extra charge. It's just part of the contract.
So that feature is exclusive to this strategy. I haven't seen it elsewhere. It speaks so much to a commitment to the flexibility of retirement because unfortunately, to your point, married couple, 30 years, buys this annuity, either spouse dies, perhaps for the surviving spouse, they want to change up how they were going to live out the rest of their years, right? It's called spousal continuance. And typically the way spousal continuance works is if I buy an annuity, a typical annuity, and my wife passes away, to your point, I'm the primary owner, and therefore I have to stay with that annuity or surrender it. And to your point, what makes this strategy so innovative is just another one of the, but wait, there's more that makes this so attractive, is the fact that if either spouse passes away, the surviving spouse can walk away from the contract, which, if you just signed up for a 9 or a 12-year strategy and in 2 years in your spouse passes away, why would a carrier, why would a company, why would any money manager not say, okay, we might need to re-examine how we're going to play this out? Another nice thing about that 30% bonus, Francis, relative to just opportunities right now, is what happens next year. The Personal Tax Cut and Jobs Act is set to sunset in 2025. So what we're seeing for some individuals is you can actually do a Roth conversion and pay ordinary income tax on that conversion right now. So if you're roughly at a 25% tax burden, you have $100,000, it takes $25,000 to pay that money to be a Roth. Not a tax expert, don't call. But if you're following me so far, so if you're at a 25% tax burden, well, this product has a 30% bonus. So it's not truly offsetting your taxes, but it is lessening the blow a little bit, because guess what? In 5 years from the conversion, the assets, the guaranteed income that comes out of that strategy, because you paid the taxes today as opposed to tomorrow, it's something we say, do you want to tax the harvest, if you will? That income stream will now be tax-free. So these are some of the innovative strategies that Francis and others utilize to just get better retirement incomes. Now, that might not make sense for everybody, but that's, again, the really nice flexibility of these products and speaks to the level of innovation that's happened in the annuity space in the last decade, which is why so many professionals are leveraging these products, and especially why so many consumers are getting a great buying opportunity right now.
I think
Sorry if
so.
the Roth stuff was wonky. I really like.
It's not
it's
wonky.
cool
I
sales
just wanted to
concept.
do,
Yeah.
no, not wonky at all. I just wanted to do a little math on it. If you had 100,000 and you pay 25,000 in taxes, it leaves you the 75,000 to reinvest, right? So that 75,000 goes into the annuity, gets a 30% bonus on it, which brings it back up to 97.5, and an 8% roll up on it, which brings you over 105,000. So, and you're not going to pay tax on it in the future. So this is an
5-year wait.
opportunity. Yeah, 5-year wait, right. But this is an opportunity for you to, dare I say, legally wash your money. It's an opportunity. I don't think so, but I just think I did, just for fun. But it is an opportunity for you to take advantage of Rothing your account at a time when you might not otherwise have done that. You just say, oh, the tax burden is so big, I don't want to pay it. There's a real resistance to that. You always have such great points, Ben. And I'm going to close this shortly, but I want to go over one major obstacle. And I had this question yesterday, in fact. Somebody called me and was ready to do the annuity. And then they said, but I talked to my friend who works for a captive agency, right, as a mutual fund guy. And he said, annuities aren't his expertise, but he says, when I die, the company keeps the money. And I said, you're right. Annuities are not his expertise. And he said, but also, he said, there's a lot of fees on these. And I said, well, he may be talking about a variable annuity. He may be talking about an immediate annuity. He may be talking about a number of things, but what he's not talking about in any expert way is this fixed indexed annuity. And so I just want to make it very clear that when you pass away, if you own this product, the money does not go back to the company. It goes directly to your beneficiaries, avoiding probate automatically. They have a check in short time, maybe 10 days. And you get to decide who gets that money, not the state, not the insurance company, you. They do not keep your money. It's not true of this annuity. If you're talking to your mother or father in this position, what do you tell them?
This is an enormous buying opportunity. We don't know. I don't have a crystal ball when rates are going to go down, but when they do, these benefits will still be attractive, but not nearly as attractive. So if you are at or near retirement, if you have a pension that you're thinking about, should I take the pension payout or should I take the lump sum? If you recently separated from service, let's not forget there's a lot of people in their 40s and 50s who have dormant, what I call dormant 401ks sitting on the sidelines. That's money that you can put to work today for your future later, right?
You touched on something I have to say. You may
Sure.
not have separated from service. You may still be employed, actively contributing to your 401k. But if you're over 59 and a half, you probably have an in-service transfer available to you where you can pick up that money from your 401k or any portion of it and roll it into this kind of a product. If you're 59 and a half or over, this is probably available to you. And you can still keep money in your 401k and still continue to contribute to it. So, I mean, we could probably talk for another 2 hours and still not get all the details about this. But the point is here, act now. I don't think I've ever said that in a video ever, but I don't want to talk to you, a month, a year, 2 years from now and hear, well, I want that 30% bonus and that 8% roll up, because I'm telling you, it's not going to be here. It will change, and it will change fairly soon. It has to when rates go down. And I think everybody believes that this is a high point. Rates will go down eventually. When? We don't know.
So if you're listening to this and you're thinking, you know what, I would like an extra $10,000 or $20,000 in retirement so I can sleep better at night, I would call Frances and get to work right away because she's incredibly busy and these rates aren't going to last forever.
If this is something that could help you, get in touch with us, and you can find us at hugyourmoney.com. Pretty easy. Hug like everybody needs a hug, yourmoney.com. Or you can reach us at 413-773-3333. Thank you, Ben Braverman, for doing this with me. You're always wonderful. You have great insight, great tips, and I love that you're not selling anybody anything directly, and you're just there to tell people what the real scoop is.
My pleasure, Frances. Thank you so much.
Thanks, Ben. You know what, Ben, as
Yeah.
usual, this last after the show chit chat.
Yeah, that was a lot of fun. Yeah, I made sure to have my double espresso this morning, so I was ready to roll. And I thought it was nice of you to be like, I typically act now. It's because there's a real sense of urgency, and I think that's an appropriate comment to be delivering to sorry, I get cold. I think that's an appropriate comment to be to delivering. And I was on the phone with an agent the other day, and he's like, what if rates go up even further? And I was like,
What if? Yeah.
you're the one only, man. Okay. Yeah.
Right.
Things could look more attractive.
Yeah.
Yeah.
Well, I mean,
But,
even if they did, what if they go up further? I get that question from people about their mutual funds. Well, but I have higher earning potential. Yeah. And you have loss potential. That's up to you. If that's what makes you comfortable and that's what you're happy with, do that. But if you're tired
Yeah.
of losses, or you're happy saying, I'll take an 8% minimum and some market gain if it happens above that, because that's the answer. If rates go up, if it goes
Yeah.
up for one day during the year, both of those columns get bumped up. I know you have to go.
All right.
Thanks.
Take care.
Bye.
Bye.